BLK. That's BlackRock. And BlackRock is a publicly owned investment manager. The firm primarily provides its services to institutional, intermediary, and individual investors, including corporate, public, union, industry pensions, insurance companies, third-party mutual funds, endowment, public institutions, governments, charities. Okay. All right, got it. So that's BlackRock. And specifically, they're an asset manager, more for institutions. These guys are a pretty good sized market cap, 155 billion. They're up nicely, 27% in the trailing 12 months. They did have that pullback I was referring to. That's just a nice, healthy pullback. I like when stocks do that. Kind of like, don't get too expensive. And it's had a decent rally. Financial services have had a decent rally because the big banks reported things look good. Most banks were really profitable. And BlackRock is not a bank, but they do have to deal with the same interest rate conditions and the conditions in financial services in general. They're a $20 billion revenue company. PE looks good for 2025. It's 21.19 and dividend at 2%, not bad. Analysts think it's a little discounted. Okay. And these guys, I don't own a company like BlackRock. So we've got revenue growth was happening 2020, 2021, 2022. Market really sold off, understood. 23 took a while. And then financial services have begun to really work. And these guys are growing at 14%. The most recent quarter looks really good. And they just reported this quarter, 22.59 growth. That looks really good. So these guys here, I'm not sure. Let's see here, net income. I'm not sure if I should treat them like a bank or like a regular company. So they have gross margins of almost 50%. Yeah, they'd be treated like a normal company. They're doing about, and I'm not sure why I'm not getting free cash flow for 2024, but 2023 was around 4 billion. So this is like a 5 billion free cash flow company. I'd probably say that they're worth 100 to 150 billion dollars, and they're above that. Let me see if this will give me the free cash flow. No, for some reason it's not reporting it through this website, but yeah, at best the company's fairly priced in my opinion. At worst, it's priced too high because the free cash flow is roughly about 5 billion is an educated guess. And if I were to multiply that times 20, I'd get to 100 billion. If I multiply it times 30, I get to 150. These guys are growing. They're in a good space. So maybe a 30 applies. Well, we just get barely up to their market cap. And that's not even considering their debt. Do they have any debt? And no, they have same cash as debt. So they don't have any debt. So this is a good stock, but it's not like crazy attractive to me. And these are the kind of stocks that, and I'm not sure if BlackRock, let's take a closer look. If these guys are going to be in the IPO market, which I don't think they are. I've never heard of BlackRock being kind of like the company behind an IPO. It's usually like Goldman or some other firm is the company that helps a business go IPO or merges.
Yeah, I think that you are right. I think that they are not. They are strong in the ETF business besides of other asset management verticals. But they have many ETF that they are issuing.
Yeah, that's where I know them from. I don't know. This one here, I think it's best case fairly priced. Worst case is they're they're priced too high in my mind. And let me look at what analysts, how many analysts, 12 analysts cover it. And the range here isn't too bad. The stock price currently is at $1,000 a share. This is basically on earnings per share, but the earnings per share growth is going to be it's going to be 11% in 2025. Revenue is going to grow at 16 and then kind of plateau. Yeah, it would be a pass for me. There's a lot of opportunities in financial services, and this one just doesn't give me enough. I mean, Citi is a stock that I just released a short on it, right? If I want to go conservative, Citi is, in my mind, fairly conservative. And I think it's discounted by like 16%. It pays almost a 3% dividend. It's really been working for the last 12 months. Had a excellent earnings report. It's up 13% year to date. And the conditions for banks are going to be very good for the next 4 years. So it's like, man, this one's pretty like low risk, very known commodity, Citigroup. They've grown their book value for 7 consecutive years. Just a lot for me to like on Citigroup. So rather than going BlackRock, I'd rather go Citi. And then what's higher risk in the same space but gives me an awesome return is Robinhood. This thing's just on fire. It's up 29%. This one's a lot riskier, right? Because for all we know, Robinhood's going to issue out a new product and it causes a lot of problems because they're a rule breaker. They're a disruptor. So notice how I own Citi and I own Robinhood, right? Citi's my like low risk, Robinhood's my high risk, but it's been doing great. And this is still discounted. I still think it's discounted by a little bit. It's still discounted by like 25% in my mind. So that's the tour around BlackRock. You know, I know who they are. I know what they do. I'm just not I'm looking at their fundamentals and saying the fundamentals are not as, in my mind, not as good as Citi. And this is lower risk in my mind than BlackRock because this is a bigger institution. We know who they are. They're regulated. And then, okay, well, I can take a higher risk than BlackRock, but this thing's been really working. And I was glad that I bought shares of this stock here. When it pulled back, I bought shares. And yeah, Robinhood right now, I think is either number one or near the number one spot for my portfolio over the last 12 months. All right, so that's BlackRock.